Now, here's an industry that's taking a hit from commodities. Our next guest says 85% of shipping is currently highly loss-making and may stay that way for the next 2 to 5 years. Andres Vogotis, Research Director at Tufton Oceanic, the largest shipping hedge fund group, he joins us this morning from Hong Kong. Andres, when you take a look at the Baltic Dry Index, it's surged, 420% year-to-date? I mean, massive gains. Are the gains justified?
Yes, the Baltic Dry Index is made up of 4 components. The one that most people watch is the Cape size, which is one cargo, one route, iron ore into China. So it's totally idiosyncratic. If you want to take a read on the health of the economy, I wouldn't look at that idiosyncratic Cape size segment of the BDI. I would go further down to the smaller ships. The smaller ships carry 40 different commodities. So they are a better indicator of the global industrial sector health. Rates there are going down. If you look at that component of BDI, it's falling and falling. And what makes me a little bit concerned is that normally you would expect the Cape-size sector to create some sympathy effect on the smaller ships. And it is worrying that you don't see that. So to me, that means it's all a one-trick pony effect from the idiosyncratic Cape-size sector, the idiosyncratic iron ore route into China.
But even though you say it's idiosyncratic, I mean, 400% surge, I mean, that's massive.
Yes, this is a fact. I think what most people want to know is how long will it last, what drove it, and is it for real? I think what drove it to a large extent, and that is for real, is the plan for the fiscal stimulus. But what gave it another push, I think, is fear about the reserve currency, which is dollars. China has told us that it's changing its portfolio from holding dollars to holding commodities. But that what is telling you is the commodities that are now piling up outside the ports of China are really an investment vehicle, is not for end use. And we are being told that 20% of that idiosyncratic Cape-size sector is now used as effectively floating storage outside China. So if there's no end use coming, that whole bubble will burst.
Andres, you are expecting the index to drop if Chinese demand abates. How soon do you see that happening?
I think we hit the limit. Look at the iron ore price inside China. It's $75. Look at the freight cost of taking that iron ore from Brazil to China is about $50. The net price that the Brazilians receive is therefore the difference, which is $25. Add the fact that that Brazilian iron ore may be sitting in floating, very expensive floating storage for days and weeks outside China, and that net $25, which the Brazilians have to pay the floating storage, shrinks to zero very quickly. So if you are in Brazil, a miner in Brazil now, you're netting zero on your cargo, you're thinking of stop exporting or stop producing. So I don't see there is mileage under these economic conditions. I think half the rise has been driven about fears about the dollar, and investors, including China being a big investor, make portfolio change from financial instruments into commodities.
All right, Andres, we have to leave it there for the moment. We'll be back with Andres Vogotis, Research Director of Tufton Oceanic, the largest shipping hedge fund group, in just a bit. For now, though, Shanghai trade has been running for about 10 minutes. Let's do a check on China's biggest companies by market value. PetroChina, ICBC, Construction Bank, all in the red, along with Bank of China and Sinopec, which is currently down by 1.4%. Let's take a look at the markets in play in Asia. Japan, South Korea, you guessed it, in the red as well. The Nikkei 225 down by 2.8, the Topix lower by 2.6, and the Kospi down by 2.3. In Taiwan, Singapore, and Malaysia, the story is pretty much the same. We have, there you have it. In the south there, the ASX 200 index lower as well. So a sea of red in Asia. The trade, well, we're off for a short break. Join us again in 2 minutes. You guessed it, you're with the trade at the top of the hour. It's time for Bloomberg Edge, and Susan Lee is here with what's in store. Susan, good morning.
Good morning, Linda. So the question of the day is, are Chinese stocks overpriced and are there values to be made? Well, you know, today on the show, we're going to have two guests to answer that question for us. And one of them happens to be the head of Asia's best performing long-short equity fund of the year, returning 93% so far for its investors. We have the head of Vision Finance China, Clive Zhang, on with us. And some of his stocks have already seen 100% plus gains on the year so far. He says they still have maybe 40% runs to go. So don't forget to tune in to see what stock picks he has in mind. Also, we'll talk to Michael Kurtz, who is Macquarie's China chief strategist, and he's also going to tell us about Chinese stocks and which ones to buy into. And you can also find earnings growth of maybe 200% over the next 2 years. So join us for that. And of course, you can email us your questions on Bloomberg Edge at asiaedge@bloomberg.net. So we're waiting for your questions. So mail them in. How's Linda?
All right, The Edge at the top of the hour. Susan Lee, thank you. We've been talking shipping with Andres Vogatis, Research Director of Tufton Oceanic, the largest shipping hedge fund group. Andres joins us from Hong Kong this morning. Andres, we have a chart that we want to show our viewers showing China's steel production fell in April while iron ore imports in May were lower than the preceding month. I mean, what does this tell us about the outlook for China's demand for raw materials in the coming weeks, in the coming months?
I think the key thing I would like to add is that the domestic iron ore production in China has collapsed. And I think this is partly pure economics, but I think it's also game theory. I think the Brazilian and Australian miners are taking a long-term view and are pushing iron into China, trying to kill domestic production to create long-term market share. And that is creating a boom in the freight market for Capesize, as we said. But I think this is long-term game theory, and I think the short-term logic will run out of steam for the reasons I said earlier. At the moment, you are netting zero on your cargo from Brazil if you are demurrage. So steel production in China, industrial production in China is up 8% year on year. In the last 5 years, it was running at something phenomenal like 18%. It went down to zero in November last year. Now it's rebounding to 8%. It's looking better. But China is not shipping and is not dry bulk shipping. Europe is very important. Japan, Korea, all the other Southeast Asian countries together are more important than China, and they are completely on their knees.
Andres, let's talk about freight for a moment. I mean, banks like Morgan Stanley, Goldman, they're pretty keen on freight, rather. I mean, how's that distorting rates and real demand?
As I said, there has been a speculative move into commodities. We have seen that happen in history in the past, particularly when you have fears about inflation and fears about the strength of the reserve currency, the dollar in our case. And these things tend to be strong, but they last for 9 months, and then they go completely bust, and they go back to where they started from. I think the last one we had was between October 1973 and July 1974. It lasted 9 months, and it finished with a 5-year bust in shipping, that is.
All right, Andres Vogatis, Tufton Oceanic, thank you so much for sharing with us your insights today.